Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Thursday, July the 16th, 2026, and we've got a packed show. AI momentum fatigue is colliding head-on with a strong earnings wave, and we've got retail sales and jobless claims hitting the tape this morning. Let's get straight into it. Lizzie, Nasdaq futures are sliding this morning even after a solid run of earnings. What's driving the hesitation?
Morning, Robert. The core tension here is that the market has been pricing AI stocks for perfection, and even exceptional results are no longer enough to push prices higher. We're seeing profit-taking dominate as investors question whether the AI trade has meaningful room to run from current valuations. Nasdaq 100 futures are down around 0.4 to 0.6%, and semiconductors are bearing the brunt of it, with the sector shedding roughly $1.8 trillion in market cap as that rotation out of chips accelerates. Wednesday closed well, though. The S&P 500 finished at 7,052, up 24%, and the Nasdaq gained 0.6%, so we're coming in from a position of relative strength, even with this morning's softness.
TSMC just posted a 7% surge in quarterly profit, and the stock is still falling. What does it tell us when record fundamentals can't hold a bid?
It tells you the valuation premium was already pricing in the good news, and then some. When a company delivers a record $22 billion in quarterly net profit, and the stock sells off, that's a classic case of buy the rumour, sell the fact. And it signals that sentiment around the AI trade is shifting from momentum-driven optimism to a more sceptical, show-me-the-multiple justification posture. The PE compression risk is real here. Investors are starting to ask whether even the best AI infrastructure names can grow into their valuations at current levels. And TSMC's reaction is a notable warning sign for the broader semiconductor complex.
We're seeing a $3.2 trillion rotation dynamic play out. Semis shed roughly $1.8 trillion, while the Magnificent Seven picked up about $1.5 trillion. Does that math add up to opportunity, or are we just watching money shuffle around?
Honestly, at the index level, it's largely been a wash. The S&P 500 and Nasdaq have been range-bound for over 2 months, precisely because those gains and losses are cancelling each other out, and the median chip stock is down nearly 20%, while the median software stock is up around 6%. The opportunity, if there is one, is in being precise about where within tech you're positioned. Memory names like Micron are in bear market territory, but software plays like Supermicro at a 9.4x forward PE, with nearly 69% annual revenue growth, represent a very different risk-reward than a semiconductor ETF trading at historically elevated index weights.
Steve, let's bring you in on the macro side. June CPI came in at 333.95 against a forecast of 334.7, a notable beat on the softer side. How significant is that, and what does it mean for the Fed?
It's quite significant, Robert. The June CPI reading of 333.9 came in below the forecast of 334.7 and below the prior reading of 330.12, which on a month-over-month basis translates to approximately a 0.35% decline, driven by falling energy prices, softer shelter costs, used car prices, and apparel. And that is a meaningful disinflationary signal. That cooler print, combined with Wednesday's PPI for June, showing a 0.3% month-over-month decline, paints a consistent picture of disinflation taking hold, which has materially shifted Fed expectations. Prediction market odds of a 2026 rate hike fell from around 73% before the CPI print to approximately 53% afterward, giving new Fed Chair Kevin Warsh considerably more breathing room heading into the next FOMC decision.
We've also got retail sales and initial jobless claims dropping this morning. Claims are forecast at 217,000 against a prior of 215,000. What should traders be watching most closely?
Retail sales for June is the higher stakes number this morning because it will tell us whether the consumer held up through a month that saw meaningful inflation relief. A solid retail sales print alongside soft CPI would suggest real purchasing power is actually improving, which is the ideal soft landing scenario that markets have been hoping for. On jobless claims, the forecast of 217,000 against a prior of 215,000 is a very modest uptick and still well within the range that signals a healthy labor market. So unless we see a meaningful surprise above 230,000 or so, claims alone are unlikely to be the dominant market mover today. Retail sales is where I'd keep the primary focus.
Back to you, Lizzie. United Health crushed estimates and raised guidance, lifting Centene, Molina, and Humana alongside it. Is this a real sector re-rating for managed care or just a sympathy bounce?
The setup looks more durable than a single-day bounce. healthcare has outperformed the S&P 500 over the past 6 months, gaining about 11.9% versus the index 8.7%. And United Health raising full-year guidance gives the whole managed care complex a more credible earnings floor heading into the second half. That said, names like iRhythm at a 351x forward PE show you that the sector isn't uniformly cheap. So the re-rating story is real, but you need to be selective. The sympathy lift in Centene and Molina is worth watching to see if volume and follow-through confirm genuine institutional rotation, rather than just a one-session read-across.
JB Hunt dropped a 45% year-over-year EPS jump with revenue up 19%. Is trucking quietly becoming one of the more interesting macro signals right now?
Trucking is one of the most honest real economy indicators we have. And JB Hunt, printing 191 times in EPS on $3.5 billion in revenue, both well ahead of expectations, suggests freight volumes are recovering meaningfully, which is a constructive signal for broader economic activity well beyond the tech sector. When you see that kind of growth alongside strong managed care results and BlackRock beating estimates, it reinforces the idea that corporate America's health is genuinely broad-based right now, not just a story confined to AI infrastructure spending.
BlackRock surged 6.6% after beating estimates, and XLF is at record highs. Does the financial sector have more room to run, or is it getting stretched?
XLF closing at a record $56 with a valuation of around 17x earnings, only slightly above its 5-year median of 16.5x, actually suggests it's not dramatically overextended, especially with banks benefiting from a steeper yield curve and strong capital markets activity, like what BlackRock and Morgan Stanley reported this week. The risk is concentration. 3 stocks drove roughly 40% of the fund's recent move, so broad XLF exposure looks reasonable here. But if the rate environment shifts or credit conditions tighten, that concentration could cut both ways fairly quickly.
Small caps are getting attention with IJR showing real momentum. Is this rotation sustainable, or is it a short-term relief trade?
Small caps tend to benefit most when inflation is cooling and the rate outlook is softening, which is precisely the environment we're in right now. So the macro backdrop actually supports this rotation, having some legs rather than being purely a relief trade away from mega cap crowding. The IGR move is worth watching because sustained small cap outperformance historically signals broader market participation and tends to reduce the systemic risk that comes from the kind of concentration we've been discussing all morning.
Let's move to crypto. Bitcoin is hovering around $64,600 and Ethereum just broke above $1,900 for the first time since February. Is this inflation-driven rally structurally sound or still fragile?
The inflation-driven catalyst is real, and the market response has been genuine. Spot Bitcoin ETFs pulled in over $181 million in inflows on July 14th, including $139 million into the iShares Bitcoin Trust, and Ethereum's weekly gain exceeded 10%, which reflects meaningful institutional participation rather than purely speculative momentum. The fragility comes from the geopolitical overlay. Iranian military developments triggered a sharp pullback to $64,000 after Bitcoin hit a monthly high of $65,500 this week, which tells you this rally is still headline sensitive and traders should be watching key resistance at $65,500 to $67,200 closely before assuming a clean breakout towards $70,000.
Bitcoin ETF flows have been volatile, a large outflow earlier in the week followed by that $181 million flowing back in. What are those swings telling you about institutional conviction?
Those swings reflect an institutional base that is genuinely interested but not yet fully committed. The prior $424 million outflow likely reflects risk-off repositioning around Middle East tensions, while the swift return of inflows, the following session suggests institutions are treating dips as tactical entry points rather than exits, which is actually a moderately constructive signal for medium-term demand. Analyst Michael van der Poppe noting that on-chain indicators are flashing accumulation signals similar to 2020, and 2023 gives some technical support to that view, though ETF flow stability over several consecutive sessions is the key confirming metric before reading too much conviction into any single day's numbers.
CleanSpark just signed a $6.6 billion AI data center lease, potentially expanding to nearly $12 billion, pivoting hard away from Bitcoin mining. Is this the template for other crypto miners going forward?
It very likely is, yes. Miners are sitting on significant power infrastructure assets that are genuinely valuable for AI and high-performance computing, and a 20-year triple net lease generating around $330 million in average annual net operating income with near 100% margins is a fundamentally more predictable and capital-efficient business model than Bitcoin mining's inherent volatility. Expect other miners with substantial power capacity to explore similar pivots, and this structural shift is worth watching in names like TeraWulf as well, though New York's data center moratorium creates specific regulatory risk for any miner with concentrated exposure to that state.
Steve, looking ahead to tomorrow, consumer confidence and University of Michigan sentiment are both due, both forecast around 51 against a prior of 49.5. Could we finally see a breakout of that sub-50 rut?
There's a reasonable case for it. Both indicators have been sitting in depressed territory, with June's actual reading of 49.5 missing the 50 forecast. But that was before the June CPI and PPI data landed with the kind of disinflationary surprise that tends to lift household sentiment fairly quickly. A reading above 51 tomorrow would be the first clean break above the 50 threshold in several months and would reinforce the soft landing narrative, which matters particularly for consumer discretionary positioning. And I'd also flag that tomorrow brings housing starts and building permits for June, with starts forecast at 1.31 million against a prior 1.177 million. So it's a reasonably full data slate that could collectively sharpen the picture of economic momentum heading into next week.
Last one for Lizzie. Netflix and GE Aerospace are still on deck for earnings. Which one carries more market-moving potential given everything we've seen today?
Netflix carries more index-level impact given its weight in the Nasdaq and its status as a bellwether for consumer spending on discretionary services. In an environment where AI fatigue is weighing on tech sentiment, a strong Netflix print with solid subscriber and revenue guidance could be exactly the kind of non-semiconductor catalyst the Nasdaq needs to stabilize its footing. GE Aerospace matters for the industrial complex and will be read closely given this morning's initial softness in the stock despite solid underlying results. But Netflix is the one with the broader narrative potential for the market heading into the close.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.